biotech is often its own worst enemy. The sector went through a big bull market, 2011 to 2015 cycle. And then we have had a series of rolling bear markets.
Biotech has been a painful trade for years, but Eden Rahim of Next Edge Capital says that's starting to change.
People have been burned. They've had a poor experience with biotech stocks, and that's how bull markets start. Even if investor interest is apathetic, they're constantly moving forward. They're innovating.
Eden Rahim has been covering biotech for over 30 years, from triumphant bull markets to devastating bear markets, picking stocks along the way. You're looking purely for game-changing drugs.
It doesn't really move the needle much. I'm not interested.
These are the kind of stocks where it's like you want them to win for your portfolio, but also just for society.
It's virtuous investing.
When you choose a Raymond James advisor, you're getting more than independent financial management. You're getting access to complete financial guidance under one roof. From tax and estate planning to trust services for generational wealth and strategies for life's key milestones like buying a home, funding your children's education, or preparing for retirement, they bring it together in one financial plan. What also makes Raymond James advisors unique is their complete independence. With no proprietary product to promote, you will benefit from personalized services, all backed by the strength and resources of Raymond James, a powerhouse with $100 billion in assets and over 520 advisors nationwide. Discover how Raymond James can help you live a life well planned. Visit raymondjames.ca. The content in this podcast is for informational purposes only and does not constitute financial, investment, or professional advice. The views expressed by the host and guests are their own and do not necessarily reflect the opinions of any organization or company. The hosts and guests may maintain positions in any securities discussed on the podcast. Always consult with a qualified financial advisor or professional before making any investment decisions. In this episode, we discuss Pfizer, which is a stock that I own. Hey everyone, welcome to a brand new episode of In the Money with Amber Kanwar. As you know, all month we have been collecting your swag meme ideas, and now it's time to vote on them. We've got the voting open right now. You can find the voting link in our show notes wherever you're listening. And I gotta say, it looks like liquid assets as the mug is going to be a winner, and market cap. I love that you guys love a pun as much as me. The market cap hat is polling very favorably ahead right now, like nearly 70%. It's never 70% of people want this market cap hat. So we'll try and make it happen. We're going to keep the voting open for the next couple of days. So smash that link, have your say, and that's what our next giveaway is going to be. On this episode, we talked about biotech. Not broader healthcare, not insurance, but right in the riskiest area of healthcare. Is a drug going to be successful or is it not going to be successful? It can be viewed as a really binary sector, and you can have huge wins to the upside. You can 10x your money in less than 6 months, or you can lose it all in like 2 days. So we've got Eden Rahim of Next Edge Capital. I've known him for years. And he is really good at trying to whittle away the risks associated with this sector. He knows a lot more than I do, certainly, about the winners in this space. But then you have to layer in the fact that this is a sector that has been absolutely left for dead, like so dead, until, a couple of months ago, it started to perk back up again. Would you believe that biotech, since the March-April lows, has actually outperformed the S&P 500 in a really quiet, stealth way? And Eden Rahim says, you want to see these quiet bull markets because that's when you know that there's a little bit of momentum. There's not hype around it. So he says, even though the sector has perked up, investors have not missed opportunities. And as always, he gave us his 3 highest conviction ideas. And let me tell you, these are not names that you'll know about. So I always like that, putting new stuff on your radar. Let's get into it. Eden Rahim, thank you so much for joining me on the podcast.
Delighted to be here, Amber.
I always love interviewing you because you know a lot about a sector that is really complex and hard to understand. It's the biotech sector. It's also been something of a heartbreaker, right? And it's one of those areas of the market where you can lose 90% sometimes in a day.
Yes.
Or you can be up like 700%. Did I capture it right?
That's exactly right.
And right now it's been, well, the last couple of months we'll get to, but for a very long stretch, it has been sort of a winter, a nuclear winter in biotech. Explain to me what it's been like to be a biotech investor over the last couple of years.
Oh, it's been so difficult over the past 10 years because the sector went through a big bull market. There was a new product cycle that gave rise to what are now household names like Gilead and Biogen and Regeneron and so on. And that was that 2011 to 2015 cycle. And then it peaked out. And then we have had a series of rolling bear markets over that period of time. The IBB has been somewhat flat for that range, but the XBI has just been, multiple 50% bear markets over that period of time.
These are two different ETFs that track the biotech space, the IBB being one of them and the XBI being the other. Just quickly, is there a material difference between the two?
The IBB holds around 280 stocks in it, and it's cap weighted. So what happens is the top 10 stocks are the largest cap biotech stocks, and they comprise 40 to 50% of that. So it's very large cap weighted, like the S&P would be. The XBI is more equally weighted. It used to be equally weighted, but they changed it a year or so ago, and they made it partially cap weighted. But it's a better reflection of what the average biotech stock is experiencing versus the IBB.
So we had this huge, the good times, 2010 to 2015. I know because I was covering the space. That's when we sort of connected.
Yes.
During the Valiant heydays when it was known then for those with a long memory. And then, as you mentioned, it all kind of went bust, coinciding with a bunch of things, but basically debt-fueled roll-ups.
Yes.
Went away, and pricing pressures splashed onto the fore, government pricing pressures. So those two, am I right, kind of acted as a big lead foot on the sector?
That's right, especially on the specialty pharma component of the market. So you had the roll-ups like the Valiants, Concordias, and so on, and all the pretenders along the way. And they weren't really R&D focused. They were really acquiring revenue streams and slashing the R&D. And so that was one model, but on the drug development side, things got very heated. And, biotech is often its own worst enemy. It issues so much supply in terms of IPOs and secondary financings, and it can become very egregious and it can beat it down. The third thing was in 2015, people forget it now, but we started an interest rate hiking cycle, right? And interest rates rose for the next couple of years from very low to a medium range. It wasn't nothing like the 2021 to 25 cycle, but it was adverse. And so we saw biotech multiples get cut in half.
So now that we've told everybody what a nightmare sector it is, let's talk about what happened. What kind of cleanup took place? And then let's say 2020. 2020 lands, and it's a moment to shine.
That's correct. And that was when COVID hit, and biotech rose to the occasion because it had the technology. In this case, we had mRNA technology, a very novel technology that came to the fore and was able to sequence the virus very quickly and develop a response using your body's own internal cells to generate superficial short-stranded spike proteins to train your immune system for it. And I responded very quickly, and the rest is history in that respect. But it put biotech on the map. But that rally that we had from April 2020 into the top in February 2021, it was a very narrow rally. A lot of biotech companies didn't participate in it. It was really the mRNA companies and a few other companies that had clinical success, but it was a very narrow rally.
So still not even a moment for full biotech to shine, and honestly, not even a moment for long-term shareholders in those stocks. Moderna still down 80-90%. Pfizer, I'll look for any excuse to bring up Pfizer because I'm down on it, and everybody knows that. But also just like can't figure out what to do with that windfall that it had, and basically squandered that opportunity. So it wasn't even a real, rising tide lifts all boats moment for the sector.
That's exactly right. And you might recall that in the summer of 2021, Moderna became the largest biotech company by market cap. The stock went to about 500. It was the largest of the biotech companies. And Biotech similarly went to like 480. And Pfizer had its brief moment where it shot up as well. I think it got into the 60s maybe at the time, and became, the largest pharma company. And then, of course, it all ended.
Yes. And how does that compare to, because, you're a biotech, but you look at other sectors. Biotech is not the only sector to have gone through this kind of dark period. I think about things like commodities.
Sure.
How does what's going on with biotech just compare to other sectors where it's just not exciting for a lot of people? I mean, when was the last time a generalist called you and said, I'd love to know what's going on in biotech?
Exactly. So here's the thing about biotech. I think that's very different. Having managed and traded commodities and other sectors and so on, biotech is constantly innovating. So even if investor interest is apathetic, they're constantly moving forward. They're innovating. And biotech controls its own fate. With a commodity company, you're at the mercy of these global markets, wherever crude is priced or precious metals are priced. You're at the mercy of it, and you have to wait for it to turn. There's very little that you can do unless you're fortunate enough to find reserves at a very low cost, which is unusual. Biotech controls its own fate. So you can have, I've managed through some devastating bear markets. So I was an early investor in Gilead, for instance, and we had that tech meltdown, the TMT tech meltdown from 2000 to 2003. Biotech fell 70%, but my Gilead position was up 200% because it was growing, it was developing drugs, it was succeeding. And I think that's the fundamental difference with biotech. It can develop a drug and its products are not tied to the economy. If you have a fatal or a chronic or a rare disease, you have to take your medication. Your life depends on it. So what the economy does has very little impact on what the revenues of these companies are. And so I think that's the fundamental difference. But so, again, biotech is so sentiment driven. You've got what investors feel towards it. And again, we went through that horrible, it was irrational. As irrational as it gets on the upside, it gets as irrational on the downside. So this 4-year bear market ended with an absolute meltdown. You had the clinical stage companies, the Morgan Stanley clinical stage biotech index drop 57% over a 4-month period from November into April. And that's on
What year?
That was last year, a year ago.
Yes, yeah.
So when RFK Jr. was announced to head the HHS, it peaked and then it started to melt down, and then it got compounded by clinical failures and policy changes. And then it just melted down into April 8th, 9th. And I put out a piece shortly after that, but the extremes were off the charts. It was off the Richter scale. And I've seen many major bottoms in biotech.
What were the extremes?
So the percentage of companies, biotech companies, above their 50-day moving average hit 1%, right? We have to go back to July of 2002, 23 years, to find a similar reading. And these are bear market ending readings. The percentage of biotech companies above the 200-day got dropped into the single digits.
Wow.
That happens once every 7 years or so. And they're always great buying opportunities. The percentage of biotech companies trading below net cash approach 30%. And again, we do all
like
the
underline
analytics.
that. That means they're trading below the cash. They're not even getting credit for just cash that they have on the book. Forget about a business on top of that.
Yes, that's exactly right. And there were some great buys that came out of that environment. Cash less debt, so they're trading below that. And we joke that in prior cycles, net cash would be sort of the floor for these companies, they got down to 0.25, 0.5 times net cash. There's one company today, Nectar Pharmaceuticals, that I was hugely bullish on. We took a big position in it. The stock was 8. It was trading at less than half times cash.
$8.
$8.
How long ago?
That was April, May last year.
Now it's 65.
That's correct. Yes.
So that just gives you a sense of like how quickly these things, and these stocks are kind of like stairs. We'll ignore what the stock was doing in 2021.
That's correct. Yes.
But if you got in, like when you saw the bottom, these stocks, like they kind of trade flat, and then it's a big gap up, trade flat, big gap up. And that's kind of what Nectar looks like. And I guess like a year ago, we should have had you on, because the plot twist to us saying that everything's garbage in biotech has been actually, since that time period, since around April, May,
yes,
biotech stocks have been quietly outperforming the S&P 500.
And that's the best way to put it, because you don't want too much excitement. You don't want too much headlines, because bull markets start quietly. It's below the radar. People have been burned. They've had a poor experience with biotech stocks for many years, and that's how bull markets start. You can go back and you can look at the apocalypse in energy stocks, right? You remember when spot crude went to minus 37 on April 4th?
Yes.
And
2020.
That's right. And 1 month contract went to 8. And the sentiment then was all energy stocks are going to go bust. And that was the bottom, right? And then they had a stellar return from that point. Similarly, we saw the same thing with gold stocks, right? It peaked out in the summer of 2011, fell for 4 years, fell almost 80%, and bottomed in January of 2016. It was up 150% in the next 6 months, and then went sideways for many years before it turned up again.
And it tests how long people can hang on. And this was personal for you. You were managing a biotech fund that ultimately, what happened to it?
Yeah, we closed the biotech fund last summer, but it was closed along with other metals funds and a private debt fund at Next Edge. So the decision wasn't so much on the biotech itself. It was another financial decision. And
other peers were closing their funds.
That's correct. There were 3 other biotech funds in Canada that were closed at year end.
Perfect timing.
Always.
As it bottomed, but you're still active.
Yes, because I consult with 2 U.S. biotech hedge funds, and it's just been great. And I knew at the time what the signal meant. It was obviously a contrarian signal. And I personally went very, very, very long biotech in August of last year, and it's just been great.
And it does come down to stock picking, I think. If you look at investing in the S&P 500, I know I have a stock picking show, but the real way to invest is just put your money in an index, don't look at it for years, and keep investing. I don't know that biotech is the same. I mean, just looking at the biotech ETF, the IBB, over the last 6 months, only half of the 250 components have outperformed.
Yes.
The other half have underperformed. The top performer is up 700%. And the worst performer is down 97%. So it really, it's a tough, there's so much fighting going on underneath the surface of that index. What does it take to be a good stock picker? What are you looking for? And are there sort of replicable characteristics that you found over your career?
First of all, you're spot on. Biotech is a quintessential stock picking sector. And you can do things to improve your odds and to handicap the risks and so on. So with biotech, you look at what the risks are. They are regulatory, financial, clinical, commercial, execution, interim, safety, competitive. So you've got all these risks, and you can handicap each of those risks. So my preference over my career has always been, and I learned this early, focus on post-phase 2 companies. So, a company spends an enormous time and money getting to a post-phase 2 readout.
What's phase 2 for those that don't know?
Sure. Well, there are basically 4 phases in developing a drug and bringing it to market. There's preclinical, where you discover a molecule that may have activity and you test it in animals. When it's proven safe and you found a dose that you think might work, you move into phase 1. In phase 1, you're testing not efficacy, you're testing dosage, safety, toxicity, things like that. Then you go into a phase 2, which is a phase 2A and a phase 2B. A phase 2A is unblinded, so you're not comparing it against placebo. You just want to see the dose effect and the potential treatment benefit. And then you go to phase 2B, where you're now comparing the drug in a blinded fashion. And so now you want to see, how does it stack up? Does it really stack up? Do you really have a drug here compared to what the standard of care is? When you succeed at that, and the failure rate is 70% out of phase 2, right? And so if
your stock will drop 70%.
Yes,
when you
maybe
fail.
more. Yeah.
Maybe more, yeah.
And so
you want companies that have cleared that already.
Exactly.
Okay.
Because you still have substantial gains, over there. Why roll the dice before then, right? Because especially with the failure rate being what it is. And you can, even the phase 2, you can handicap that by looking into the design of the trial. Is it well designed? Is it a large trial? Is it targeting the right patient population? Things like that. So you can handicap to improve your odds of success. But coming out of phase 2 is my favorite phase, because you can look at the data. And again, you can, exactly what I just described, you can look at these things and then say, well, now we know how to power a phase 3 trial for success. We know how to find the right patient population. And then I often source out key opinion leaders, KOLs.
Yes. Right? I just learned about that acronym. Yeah. I was reading an analyst report and there were KOLs all over. And I'm like, what is this? Yes, it's a key opinion leader.
Yeah, key opinion leader. And so these are leading practitioners in a certain treatment area. And they will look at the data, they'll analyze it, and they will. And for me, one of the chief determining aspects of it is, in their opinion, will this change or improve how they're able to treat patients? If it's a Me Too drug and it's maybe we can add this to this, but it doesn't really move the needle much, I'm not interested.
So you're looking purely for game-changing drugs.
Yes.
You're not playing anywhere else, typically in healthcare, like medtech or big pharma even. You're right in that most speculative area.
Yes, but a speculative area where you can really handicap the risks. I do like some medtech companies, but again, they have to meet certain criteria. We're going to discuss one of them today.
Okay, I like that. Yeah. Look at you understanding the show.
And it's blue sky, right?
Okay, all right. So we're going to talk about that. Yes, you did bring 3 ideas with us. But one of the things you talked about was like going through these trials and, how, efficacy matters, finding these key opinion leaders. Am I wrong in saying, though, that the regulatory environment has become more of a wild card with the FDA in particular? From what I've been reading, that there's been decisions and approaches. I think we're just seeing something with Moderna today that are another risk that maybe a couple of years ago you didn't have to handicap.
Well, Amber, I couldn't have said it better myself. You actually nailed it. And so here's a contrasting view. During Trump's first term, he announced Scott Gottlieb as the FDA commissioner. Gottlieb was very pro-innovation, especially for new sciences that were coming along that could treat previously incurable or untreatable rare diseases or cell therapy-oriented diseases and so on. And he really advanced that. He pushed that forward, which is a real benefit. We've had cures come out of that approach. Now, the negativity that we thought would come with RFK actually hasn't been that. So McCary was announced as the new FDA commissioner. Again, very favorable. He's been pro-innovation. He's just introduced a new voucher program for innovative developments and so on. He's working with the industry to find out how do we bring the best treatments forward as quickly as possible. He's introducing new reforms, especially for eliminating animal testing and preclinicals and using technology which benefits some of the AI ML companies that are out there like Schrodinger and SLP and so on. They will benefit from that. But the real wild card has come out of a wrecking ball that joined the force, and that's Vinay Prasad. He has introduced so much uncertainty. He has moved the goalposts when it has come to certain drugs. And, we can name a number. You saw it with Moderna last night.
So just for context, Moderna has a flu shot that they'd like reviewed by the FDA.
Yes.
And the FDA abruptly, surprisingly, said they refused to review it. So it's not even anything but the trials. Presumably it's gone through all the trials.
That's correct.
And now it just needs FDA approval, which 5 years ago would have been an easy event.
Absolutely. It would have been an easy event.
Now they're saying, well, we actually don't think that this approach, this mRNA flu vaccine, is better than the best available standard of care. So we're not even going to review it.
Yes. So they felt that there should have been another control in it. But again, as has happened with several companies, and I'll tell you about another, like Exhibit A, they've moved the goalposts. So the companies had an agreement with the FDA and the division within the FDA that's going to review it. FDA tells them what are the guidelines, what you have to measure, what are the conditions for doing those measurements, and so on. That's the benchmark. And then when they submit the data and the data succeeds and exceeds those benchmarks, the FDA has come back and said, oh, no, we think you should do this. That's what's happened. So if you look at a company called Unicure, Qure, they are developing a cell therapy for Huntington's disease. Huntington's disease, there is no treatment. It is it's debilitating. It rapidly degenerates. There is nothing out there. FDA and Unicure agreed to what the trial should look like. They reported the data in accordance with it.
Was that in September?
That was in September.
I'm looking at the chart.
I was long Unicure.
Okay, yeah.
And exploded 200%, 300%. And that was great, right? It would be a multi-billion-dollar market. The Huntington's disease advocacy groups were excited. The data was transparent. KOLs loved the data. The KOLs that are treating patients, they love the data. Vinay Prasad in November comes and does an about face and says, no, we don't think that that's acceptable. After FDA rubber stamped the design and everything, the readouts in April of last year, right?
And so the stock tanks.
It's stock tanks.
It's a little bit higher than where it was before the September release, but what do you do?
So I think it's a buy, and here's the reason why. I think what's going to happen is they just can't do something like that. They have data. There are advocacy groups that have pointed this out, KOLs that have pointed it out. There is no available treatment. They abided by the conditions that the FDA had stipulated. I think what's going to happen is they will be granted accelerated approval with the expectation that they can run a phase 3 trial.
Under this administration?
Yes. I think they would have to backtrack on this. This is untenable. So I think they would do something like that. We saw something similar with Amylyx's drug in ALS some years back. They were granted, again, because there were no acceptable treatments, they were granted accelerated approval. I was bearish on it. I thought the drug would fail, and it did fail. They subsequently ran a phase 3 trial and it failed. I don't think this Huntington's disease drug, AMT-130, is going to fail. I think it is a success, and you can't deny patients the right and access to that.
So that's another thing for investors to be prepared for, is that you've got a bit more of a wild card in the FDA. Sounds like your bet, though, is if the drug works, stick with it.
Stick with it. I think it's an opportunity. And, and there are other examples, Capricor and so on, went through exactly the same thing. And so it has introduced a fair amount of uncertainty.
What's the Capricorn story?
CAPR, again, a similar drug. They agreed to certain terms on what the trial should be. The stock had soared based on the trial outcome, and then the goalposts got moved.
But we didn't see such a huge plunge in the stock.
No, and because they still had another trial that was ongoing, and they reported that trial, I think a couple of months ago, and the stock soared right back.
I saw that. Yeah. Yes. Okay. So that ticker is CAPR for those who want to do their homework. We're going to talk a lot about this. We've got some questions in the mailbag, but we're really focused on US, right?
Yes.
What happened? Our publicly available stocks in Canada for biotech are thin to begin with. Some people will say that is a valuation opportunity because it's like an ignored pocket within an ignored sector. Mm-hmm. How do you think about Canada versus US opportunities in biotech?
The biotech industry thrives in the US because they have a different culture when it comes to risk taken and especially money spent on R&D and so on. I think we need more incentives, flow-throughs and things like that we can do here to help with R&D spending. And if you are developing a drug, you will go to the US, you will seek patent protection there. The patent laws are better there. And, we do have good science here and, we have incubated some really good companies, but inevitably they move south. So we have one Canadian company that's going to read out in schizophrenia in March, and it's successful, had great phase 2 data.
What's the name of the company?
Xenon.
Yeah.
It's XENE.
So it's Canadian, but it only has a U.S. listing.
That's correct. And there are others like Aurinia, Promis Neuroscience, and and others where they've just delisted in Canada and moved because that's where the investors are. And in Canada, they love bank stocks and resource stocks.
We know.
Yeah.
All right, let's dip into the mailbag. We do have a few questions before we get to your pro picks.
Okay.
The mailbag is brought to you by BMO ETFs. If you're a do-it-yourself investor looking to take control of your portfolio, BMO ETFs makes it easy. Whether you're exploring stock replacement strategies or you want to find ETFs that hold your favorite companies, their tools are built to help you invest smarter. Check out the ETF Compare tool, the stock replacement tool, and news and insights under the tools section at bmoetfs.com. It's perfect for analyzing your options, spotting trends, and building a portfolio that fits your goals and timeline. Okay, the first question in the mailbag is Sarepta, and this I feel maybe you tell me has parallels to the Cure story that you told me in that it treated Duchenne muscular dystrophy, which is a condition that affects children.
Yes.
Very debilitating. And there was so much controversy. This even predates, the Trump administration around the approval of this. There was denial and then advocacy and then approval.
Yes.
And then look at the stock chart and it's just completely imploded. Tell me a little bit about the Sarepta story. The question is, why has it melted down?
Sure. Sarepta was a huge winner for us back in 2017. I remember that I was listening to that contentious panel, and the instance was they had a very small patient population of young boys that they had treated. There was anecdotal evidence that there was benefit because parents knew it, the groups knew it, but it wasn't a controlled trial. And the panel voted to not have the drug approved. Stock tanked. The head of the FDA, Janet Woodcock, I think at the time, overturned it and approved it. Felt patients need to have access to it given the conditions. By their mid to late teens, they've deteriorated so much they're immobile. Again, they got approval. It's very similar, which is you get approved, but you have to run a trial. They delayed in running that trial. In the meantime, Sarepta went from, so when it got approval, it went from the teens up to about 64. It then got cut in half. We bought in at $32 a share. It then ran up because...
this is 2016, 2017.
That's correct, yes. It then ran up to about 160. And
all on hope?
No, so the numbers were coming through.
Okay.
So there's a very small patient, but again, when you're dealing with rare diseases, that's the opportunity in biotech. You don't need a big patient population. In the case of Sarepta, the treatment cost is, I would guess, around $250,000 a year that got reimbursed because it's very small. You're dealing with 100 patients at the time.
Mm-hmm.
So it became a very successful company at that time. The market cap gave them leverage to raise funds and then acquire other technologies, related technologies, and then further develop. So the aim is have a therapy that can cause the body to produce more dystrophin. And that was their approach. And as they targeted different areas to produce dystrophin, the trials failed.
Mm-hmm.
And faltered, and there was a circus of stumbling that occurred. We've been out of the stock for a very long time.
Mm-hmm.
We just thought it was fully priced, and we realized that they were trying to find new areas of growth, and we weren't enthusiastic at all about it. I still haven't bought into it yet.
Because it's down.
It's down, but I feel like there are other areas that are developing treatments right now that are emerging, and they will get caught up to some degree. So I feel like for Sarepta, the ship has sailed for, it's undervalued.
Mm-hmm.
It's at an equilibrium point. They're slashing expenses because they want to turn a profit. They don't want to burn cash anymore. But it's not the company that it once was. So you're buying something different. It's like buying Valiant, when we had $10, you're just buying this debt bomb,
So you don't buy that. What's it called now? Bosch.
Oh yeah, sorry. I knew it from BioVail to Valiant. I'm lost track.
I have lost track on that too. I was really on that story back in the day. Sticking with Sarepta, there were also deaths in 2025.
Yes.
In people with this disease that were immobile.
Yes.
And has that, what do you do with something like that?
So these things occur when you're treating chronic debilitating diseases and ailments like this. The thing to determine is whether the treatment itself is contributing to what that cause is. And in this case, there is a particular viral vector. It's called an AAV.
Mm.
So AAV is a virus that is used to attach a drug to because it naturally infects. So a virus naturally infects certain cells.
Uh-huh.
So you have different gene therapies that will use an AAV virus, others that will use a lentivirus.
They're using a virus to deliver the medicine.
That's correct. Now, these viruses aren't harmful. They've been denuded to the point that, but they have a natural instinct to invade certain cells. So for instance, Spark Therapeutics developed a cure for a certain rare form of blindness, and it used a virus to deliver into the eye to deposit the gene that would correct lost vision. And so these gene therapy companies use that. And in this case, there has been some side effects associated with using this AAV virus to deliver certain therapies in certain cells. And that's what the FDA was concerned about. So that doesn't go away. And there's another company, Regenex, that, again, similarly face the same thing.
Okay, so these are questions on biotech. We do have a couple on other areas within healthcare. One, a very patient, James Gordon McLean, has been asking every guest about Well Health. Mm-hmm. And nobody can answer it.
Yeah.
So hopefully you can. Well Health down 33% in the past year, but analyst price targets suggest an 80% upside. Why the disconnect? This is not a biotech.
No.
This owns a portfolio of healthcare facilities.
That's correct. So again, I know the CEO. I had him on my panel. I believe it, the Cantech panel back in 2019.
Okay.
I hosted a panel on AI impact on healthcare. How about being ahead of the curve?
Yes, there you go.
And so I had Shabiz being a software engineer, a software entrepreneur, sorry. I had him on because he would have particular insight into that. Well Health was just getting going at the time. So again, it's interesting company. I don't particularly invest in service companies and so on. And I'm always concerned about what the regulatory environment is in Canada to have that sort of growth by acquisition, because it's such a regulated industry. I mean, it's not like an oligopoly regulated industry like the cable companies and the banks. So this doesn't have the luxury of that. So it's just something I don't quite know. There are too many uncertainties there.
Mm-hmm.
But they do have a software. So again, it's reasonably priced. I know they made forays into the United States and so on, but Canadian companies venturing down there often don't succeed in a service environment. So it's going to be a steady as it goes type business. I think it's growing at around maybe 10% to around mid-teens, which is good. And I know he has significant ambitions to grow from 1.5% of healthcare services up to 10% over the next decade, which may be possible, but I think you have regulatory roadblocks and so on, which means you have to also do a lot of integrating of acquisitions.
Mm-hmm.
And I don't know, oftentimes you get the best acquisitions early and the not so good acquisitions later on. Just like the best IPOs come early in a bull market and the worst ones at the end.
Yeah.
So I don't know how. So, I think there's some execution risk associated with that growth. But that said, I think they will be spinning off a software company that is landing certain provincial contracts. So there is an opportunity there. I find often spinoffs from companies are often pretty good investments, once they're able to tap the capital markets and so on. So again, I'm neutral. It's not what I tend to focus on.
Yeah.
But credit to him for executing well.
That point on spinoffs, there are spinoff ETFs that people can buy.
Oh, really?
Yeah. There's an Invesco spinoff ETF and a VanEck spinoff ETF. The tickers are CSD and SPUN.
Well, so you got an ETF for every
there you go
carve out in the market.
Okay, our next question is on DRI Healthcare. Not a pharmaceutical play, but pharmaceutical adjacent. They're a pharmaceutical royalty company. And this one has actually done really well over the past year. We have a question from Panet on X. What do you think of it?
I like the company. I like the team that manages that company. And I have an interesting story that goes back how I actually met them and discussed it. It was maybe about 3 years ago. I had invested in a company called CTI Therapeutics. They had reported successful phase 3 company for their drug Vonjo in myelofibrosis. And this is a company I'd been bearish on for 20 years. And I pivoted when they had successful phase 3. The stock got cut in half after the financing. And so I had taken a long position in CTI Therapeutics because I felt now I basically put my tail between my legs and reversed my position from bearish to bullish. And I thought they would carve out a really good market in myelofibrosis. The data was good. And so we went long. And then I saw a few months later, DRI actually finance, and which it's interesting financing from a shareholder standpoint. It's non-dilutive. And so the company was willing to surrender some of their upside revenues to get this non-dilutive financing to finance the launch. And this is pre-FDA approval. And DRI had given them an additional incentive on FDA approval, which would occur about 6 months later. I think this was August. And then they got approval, I think, in February the following year. And so I had to meet this company because I had done my due diligence, but I was really looking forward to actually finding out what their due diligence. Again, pivoting from bearish for decades to bullish is difficult. You feel very lonely. And so I met them at the Bloom Burton conference the following year, and we sat down and we took a deep dive, and we compared notes, and I saw their thought process, and I was really impressed. I thought the quality of work they did, the due diligence was really good, especially if you have to take that risk. Now, I took a position in the stock at the time as well. It was single digits. Unfortunately, I'm long gone, and I left a lot of money on the table. But I do respect their due diligence, and they've repeated this for several other drugs. I think they have a drug from Viridian. They have a drug with Lilly, and so they built good value.
So they're shrewd.
They're very shrewd.
They do what you do.
Yeah, they're very shrewd. They have a team. They hunt down where royalties would be available. They approach companies. And because they're giant players, like there's Royalty Pharma and so on, they're giant players that are out there, pension funds and so on. They've carved out this smaller niche for smaller drugs that ordinarily wouldn't be large enough for these big players. And so good on them. There'll be plenty of opportunities. There's always risks involved because you're taking clinical and regulatory risks. You're handicapping trial outcomes and what the FDA will do or not do, and you're handicapping what the commercial success might be.
Kind of a unique play on biotech because it also spits out a dividend.
That's correct.
Right? It's like, so you're getting the risk exposure and you get a 3.5% dividend yield because it's royalties.
That's correct. And now, they take a fair amount of leverage. So, their debt to EBITDA is approaching 3 times.
Yeah.
Their EBITDA is very strong because obviously you're collecting percent of revenues and so on. But they do leverage to do that. So if you're comfortable with that, to me, it seems like it's a decent long-term play.
Okay, well, let's find out where your convictions are and get into your pro picks. Pro Picks is brought to you by ATB Financial. With over $100 billion in assets, ATB Financial is powering possibilities for more than 843,000 financial services clients. ATB Cormark Capital Markets is a leading North American investment firm providing holistic corporate and capital markets advice and full-service financial solutions. Visit atb.com/inthemoney for more information. Okay, I left these because none of them are household names. So you're really, bringing some information that I think, you don't find on like CNBC, BNN, front page. They're not the Meg 7. So we'll talk about what the risk profile is when you're doing stuff like that. But your first one is Alpha Cognition, trades on the NASDAQ, ticker ACOG.
Yes, and that's actually a Canadian company. So I followed them for 4 years, as I often do these companies, meet with them and have calls with them before I ever decide to invest. And what it is, it reminds me of another company I'll tell you about afterwards, a Canadian company that was a huge success. This company has developed a better formulation for an Alzheimer's drug that treats cognitive deficits. So there are 3 generic drugs out there right now that treats cognitive deficits that have a similar mechanism of action. It's an acetylcholine esterase inhibitor. And what that does is acetylcholine helps your brain process thoughts and so on. As you incur deficits, your cognition falls with that. This drug, as well as generic Aricept and galantamine, helps improve that. So your first line of treatment for Alzheimer's is to get an acetylcholine esterase inhibitor treatment.
And you're saying alpha cognition is better?
Yes.
Okay.
So one of the side effects, or a couple of the side effects of the existing generic drugs is that there are gastrointestinal side effects. There's insomnia. And so compliance is not good. So you tend to shuttle through each of those and hoping to find something that is sustainable long-term. And so inevitably, you just give up. What Zunville does, which is the therapy that they did, it's a reformulated version of an acetylcholine that has esterase galantamine that has now clinically and FDA approved proven that it has better bioavailability with much lower side effects.
So why has the stock been under pressure?
Oh, that's the market, because most small cap biotech stocks have been under pressure.
So nothing specific here.
No, it's nothing specific other than, maybe people are uncertain of what the launch might be, but I think it's just a golden opportunity.
We spoke with a healthcare fund manager a couple of episodes ago, and he was pretty bearish on treatments in general for Alzheimer's because it's a really tricky area. You need to kind of treat it before you know you have it in order for it to be effective. And that's kind of a difficult equation. What do you say to that?
The failure rate in Alzheimer's is basically 100% for drugs. If you can go back until aducanumab, which didn't succeed, but Leqembi, from Biogen was approved, the first biologic, the first disease-modifying drug for Alzheimer's. You'd have to go back to 2003 for when Namenda was approved. So you're looking at 2 decades of failure, clinical failure. And that's due to a couple of things. First is the bar that the FDA had set was too high. So you had to prove statistically that you achieved efficacy in both cognition and function. Well, which disease has to have 2 dual endpoints to succeed at? So FDA had a eureka moment and went back and said, okay, we're going to change this. So you've had major pharma companies bow out, Glaxo, Pfizer, all of it. They said, we're not blowing billions of dollars anymore in this. It's just unachievable. So FDA changed the rules and said, you need 1 trial and you can prove either or of it. You can use one as a secondary, one as a primary. So the landscape for Alzheimer's is improving. There are over 5 million diagnosed in North America. It is the biggest treatment frontier that's unaddressed right now. You saw how difficult it was for Leqembi to get in there because, again, it's IV, but they have a sub-Q version of it, right? That's going to be approved.
Subcutaneous skin. Yeah, okay.
And so, again, administration will be easier. When Leqembi was approved, there were all these conditions. You had to have an MRI to confirm your diagnosis and all these things. Roche has an Alzheimer's drug that's coming, and it's shuttled with new technology that is able to cross the blood-brain barrier much easier, get greater quantities of drug to the plaque and so on. So that's coming. But you need to get one approval to have another approval, to have another approval. Think of it like HIV, in the 1990s. You had to have Biochem Pharma's 3T. You had AZT, which is toxic. And then you had first a Canadian success story, Biochem Pharma's 3TC or Epivir, partnered with Glaxo. And then you had a series of other companies built. And then eventually you had PrEP from Gilead, right? Combining all these. It's the same thing with Alzheimer's. You need to have one approval to have another to incentivize companies to develop. And there are different mechanisms of action. And there is a host of really small companies out there. Like it as bleak as it is for Alzheimer's right now, it may be one of the greatest opportunities for investor returns looking out at 5 years.
Does this get taken out? Have all these names here, do you think eventually get scooped up? Is that kind of how you play it? Good results and then gets taken out?
So these companies, I'm not thinking in terms of a takeout because I think all the companies at least 2 of the 3 companies were here, they're going to have 100% revenue growth every year for the next 5 years.
Is Alpha one of them?
Alpha is one of them.
Okay.
Right? It's going to have, it launched last year, but this year it's going to be targeting Medicare-covered long-term care facilities, which is an addressable 250 patient market. And to get reimbursement, all the patient has to do is to have failed one of the 3 treatments, which is
a low bar.
Your
second one is ClearPoint Neuro.
Yeah.
So I feel like there's a theme. We're targeting the brain.
Yes.
What does ClearPoint do?
So ClearPoint has this revolutionary device that is able to deliver drug deep into the regions of the brain and the spine. It's an interesting story how actually, you never know how you discover great companies.
This is the medical device
company. That's
yeah.
exactly right. And if you look at the chart, you'll see that it had a giant move, a 200% move, and then right back down. So it was anchored to Unicure.
I was just going to say, it looks exactly like the Unicure. Yeah. Okay. So that's why.
Yes. Now, that's an overreaction on ClearPoint because they're partnered. Before I jump there. So this device is very innovative. So how I discovered it was in September of 2016, I was at the Mizuho Neuro Conference in Boston, and I was speed dating with a bunch of neuro companies, including Vivek Ramaswamy's Axovant.
Okay.
So I sat down for an hour with him. And
Vivek?
Yeah.
Wow.
Yeah.
Okay. Let's park that. I want to know what that was like.
Yeah. So I met Voyager. And Voyager was working on a therapy to deliver deep into the putamen region of the brain. So I asked the CEO, well, how do you get the drug there? And so he says, we're partnering with this little company that has a device that's able to get the drug in deep regions. At the time, Clairpoint was unknown, completely under the radar, had revenues of around $6 million, and was trading for around $2. Fast forward 6-7 months, I've had a couple of calls with them. It's Victoria Day. And instead of us getting out of the city, I do 2 calls with the company. My wife was not too happy. And then we did a financing. We did a big financing at $2 with a 5-year 220 strike warrant. 4 years later, the stock was in the 30s. We sold out. And then, of course, the bear market hit back down to $5. Bought again. And what it does, it's partnered. So in addition to selling a neuro device in 100 neuro centers and have executed on 7,000 treatments so far, the real interesting thing for this is that, so its revenues are going to be 35 million for 25, 55 next year, for 26, sorry. But really, there is this blue sky opportunity. It is partnered with 60 biopharma companies, gene therapy, and companies like Unicure to deliver therapies in unreachable areas in the brain, right? So drugs that had failed, brain drugs that had failed in the past, because now have a second life.
The right place.
Exactly, because you can't get enough drug. You've got the blood-brain barrier. And so this company has a call option on all these programs without the binary risk. So you take something like neurology. They have 9 partnerships with companies that have 7 indications under fast track review with the FDA. If you get a tiny percent of those 2 million addressable patients, you're looking at $250 million to $500 million in revenues because they'll collect.
Right now, it's like forecasted to be 55 million.
Yes.
So it's a small company.
Yes, but that's it's massive blue sky upside. So I'm very bullish on this long term. I hope they don't get acquired.
But a lot of volatility, as we saw.
Yes.
So be prepared.
Yes, and they've been hurt recently because of the FDA's stance on AAV delivered treatments, right?
Quick detour for your Vivek Ramaswamy story.
Yeah.
What was that like? And
so he was the CEO of Axovant, who was
this is before?
Yes, this is September 2016 in Boston.
Okay.
And his Axovant was bought a repurposed drug from Glaxo for Alzheimer's. And again, he's very charismatic, very intelligent, and we dialogued for about 50 minutes, and it went by in a heartbeat. He had been successful as a hedge fund manager. He was one of the early investors that had figured out. So Gilead had bought a company called Pharmasset in phase 3. So Gilead, had a great phase of growth in HIV. And then even though we had started a new bull market 2009, 10, 11, Gilead was going down. And its market cap was about $25 billion. It took this massive bet, buying this phase 3 company, Pharmasset, paid $12 billion for them. They bet the farm on it. Mm-hmm. Well, that became the drug Sylvania and Harvoni, which cured hepatitis C, right? Well, so Vivek was also he'd figured out that then. So that a big part of his success was getting that. So he had a Wonder Boy sort of reputation when he came. Axovant failed, stock crashed, as all Alzheimer's companies inevitably do.
Yes. But not this one that you put on our radar, Alpha Cognition, hopefully. Yeah,
no, because you see, it's already approved.
Yeah.
And it is, so 15 years ago, there's a little Canadian company I bought, Cipher Pharmaceutical.
Oh, yeah.
They had developed a version of isotretinoin, which is basically Accutane, which is severe acne. And there are 2 generics in the market. And this little company had developed a drug that had better bioavailability, as did Alpha Cognition. Mm-hmm. And they partnered with Dr. Reddy. And they got 25% of revenues and Dr. Reddy kept the rest. Well, that became a $100 million drug, and Cipher went to $19, right? Just on that, just tiny amount of leverage that these microcap companies can do. I feel alpha cognition is something like that.
Okay, thank you for that detour. Let's bring it back to your third and final pro pick, NRXS.
Yes.
Tell me about this one.
So there is a pediatric indication that results in severe abdominal pain due to IBS.
Mm-hmm.
And there is an adult version of that called functional abdominal pain, FAP. They developed a device called the IV Stim. And what it is, a device worn over the ear for 5 days, replaced with a new device for another 5 days for 1 month. So 4 devices for 1 month. The clinical data is exceptional for patients that have no relief from the pain, a chronic condition, especially pediatric patients deemed 8 to 21. And it has
Why does wearing something on your ears help your stomach?
Good question. It's called disorders of the gut brain, DGBI. And what it is, it stimulates the vagus nerve.
Mm-hmm.
And the vagus nerve is what is part of that interaction. And it changes what signals is sent from the gut to the brain. And that changes everything.
I know a few people who could use that.
Yeah.
Okay, so NRXS, very small cap.
I can put them in touch with the CEO.
Very small cap.
Yes.
Sub 50 million.
Yes.
So high risk profile.
Much less high risk.
Okay.
Again, I think it's really set up. You know, the thing is, when you enter a new bull cycle, you know, you're not facing the headwinds that you did the last 4 years. And the market will be more receptive to a tailwind. And this company coming into this year has 3 tailwinds.
And you think we're entering a new bull cycle?
Yes.
Sorry,
especially for Biotech. Yeah,
what
no, that's okay.
3?
So 1, it got a CPT-1 code. That's the best imaginable reimbursement code a company can get. And you can only get that if you have a best-in-class therapy and then everything else is inadequate. That's the only way you can get a CPT-1. What that means is that hospitals will get seamless reimbursement and doctors will get compensated for providing the treatment. The second thing is that they're getting covered. So before they get the payer coverage, there is a policy paper put out by KOLs treating this ailment that validates and stands by the efficacy of this treatment. So that's important, especially for the payers. And so they're getting reimbursement payers. So they now have reimbursement coverage, very broad, not conditional, from payers like Anthem that now covers 20% of their lives. Now here's a commercial opportunity. Every treatment is $1,200 that they receive. 4 treatments, $4,800, let's say $5,000. Mm-hmm. There are 6 million with functional abdominal pain. 10% is your immediate addressable market of pediatric abdominal pain due to IBS. That's 600,000. 600,000 times 5,000 is a $3 billion addressable market. And that excludes the adult market. We're not even counting the adult market, which obviously is addressable.
All right.
So there are 260 children's hospitals. That's a low-hanging fruit.
These are the kind of stocks where it's like you want them to win for your portfolio, but also just for society. It'd be really nice.
It's virtuous investing. It's virtuous investing. And these are all game changers.
Eden, it has been an absolute pleasure. Thank you so much for joining me.
Wonderful discussion, Amber.
That's Eden Rahim joining me. If you want these pro picks right to your inbox, visit inthemoneypod.com and you can smash that subscribe button and you will never miss some of these high conviction ideas. We'll see you on the next episode.